U.S. economy accelerates beyond forecasts in the second quarter. Welcome to Market Insight. I'm Peter Devlin. U.S. economic growth grew at a much faster pace than expected in the second quarter. Headline GDP surprised on the upside, coming in at an annualized 2.8% compared to last quarter's revised 1.4%. Economists expected a rate of 2.0%. This comes ahead of tomorrow's PCE price index, which is expected to show a core reading of 2.5% year-on-year, down slightly from May's number. So what does this mean for the Federal Reserve meeting next week? Joining me now to talk about all that is Jeff Schulze, Head of Economic and Market Strategy at ClearBridge Investments. Welcome, Jeff. So starting with today's robust GDP reports, have we seen an end to the Goldilocks scenario? Slower growth for the economy paired with lower inflation.
Yeah, this was an ambiguously good GDP print at doubled the pace that we saw in the first quarter. And even though inventories contributed to the GDP print, there was a lot to like about it. Consumption jumped up to 2.3%, and private sales to final domestic purchasers, which is like a core GDP level, that takes out some of the more volatile areas like inventories, government spending, and trade. Kind of tells you what the trend of the economy really is. Came in at a really robust 2.9%. So this was a great print, and it shows you that the slowdown that we saw in the first quarter is now in the rear view.
So turning now to the Fed, and yesterday, former New York Fed President Bill Dudley argued that economic conditions warrant a rate cut at July's meeting. So what can we expect next week?
I think a July rate cut may be premature. There's no smoking gun in the labor market that suggests that the Fed needs to act today. So they do want to see a couple of more inflation prints to be certain that disinflation will continue as we move through the third quarter. So I'm expecting the Fed to talk about the progress that they've made on inflation. They're going to talk about if that progress continues, that they will do a rate cut in September. And they just want to see more data. But I do think that the Fed ultimately will cut in September. And the markets are pricing in another 2 cuts in December and January, which I think will come to fruition, which is a really positive dynamic because with the research that we found, if you do 75 basis points worth of rate cuts, traditionally that's enough to cause an economic reacceleration, which we're expecting in 2025. So I don't think we're going to see much of a surprise in July's FOMC meeting, but September will be the beginning of that rate cutting cycle in our opinion.
So looking now to September and the Fed's preferred inflation reading, PCE price data out tomorrow. So traders are pricing in around a 12% chance of a 50 base point cut in September. Could a lower reading tomorrow than expected push the Fed to begin its easing cycle with a bang?
I don't think so. With the GDP print that we got today, it did show that core PCE was a little bit firmer than what consensus anticipated. So I'm not expecting a big downside surprise to core PCE tomorrow, which would really change the calculus for the Fed. So now that we have CPI and PPI, it's really easy to leg into what tomorrow's print is going to be. And it's going to show progress, but just not enough progress to be a little bit more aggressive on the rate cutting front.
Over to the stock markets now, and the Magnificent Seven posted its worst day since September 2022. A rotation has also made its way into investing sentiment in recent weeks. Is this a natural progression in the face of lower rates or an overvaluation of mega-cap stocks?
Well, I think it's a reflection that the economy is not going to go into a recession and that we're going to get a reacceleration of economic activity with that cutting cycle that we're anticipating later this year, which should create a better earnings delivery for small caps and other companies outside of the Magnificent Seven. In fact, if you look at earnings expectations, this quarter is the last quarter where you're going to see significant Magnificent Seven earnings delivery. Next quarter, that earnings delivery is about in line with your average stock in the S&P 500. And then as you move out to Q4 and Q1 of next year, the average stock in smaller cap companies are expected to outgrow their earnings versus the Magnificent Seven. So I think it's a combination of this recognition that earnings are getting more broad-based, and we're going to likely see a soft landing should the Fed be able to deliver on these rate cuts that are expected.
So keeping with the current earnings season and Tesla and Alphabet yesterday, following many traders are questioning the longevity of the AI trades. With Meta and Apple set to report next week, will traders be cautious despite how they perform?
I think there is some caution. Obviously, Alphabet did beat expectations, but not by enough to create upward momentum in the stock. And Tesla had a pretty broad-based miss. But ultimately, I think there's a questioning of traders of how much more money is going to be needed to invest in AI and when is that payoff ultimately going to play out. So I think that when we get the earnings next week, that's really going to drive the momentum of this trade that we've seen from growth into smaller cap companies and value. But ultimately, these are great companies that generate a ton of free cash flow. I think they're going to be all right and potentially have a bounce if we get some better earnings numbers next week.
Thank you, Jeff Schulze, Head of Economic and Market Strategy at ClearBridge Investments. That is your market insight. Don't forget you can watch more videos on Reuters.com.